Good morning, everyone. For those of you who can hear me, I hope you can hear me. I'm Paul Sturgis from PASA, and we're here to talk about GMP. And now, when I joined the pensions industry, I'm almost embarrassed to say in 1979, GMP was new, was just on its way in. And my boss at the time said to me, "This is going to be the last bit of government meddling in pensions," and that proved not to be true. So here we are, 42 years later, and we're still talking about GMP. Now, this is one of a series of webinars that PASA are running this week, and who would have thought we had several hundred people coming to a webinar yesterday, and I think we're just south of 200, and there's people joining all the time. So thank you for joining. We've got two very respected speakers in this space. We've got Geraldine Brassett, who's chair of the GMP Working Group, and she will be talking to us in a little bit about some of the practical natures of what we're doing. But we're going to start with Duncan Buchanan, who is chair of the GMP Equalisation Methods subgroup, and his day job is at Hogan Lovells. Now, one of the joys of webinars is that you haven't got to wait until the end to remember your question. You can raise them as we go along, and if you look at the little toolbar, you've got some little kind of little arrow pointy things. If you can use that questions bar, please raise your questions as we go through, and then we'll deal with them at the end of the session. So thanks for joining, and I'll now hand over to Duncan.
Does that work? Thank you, Paul. Yes, good morning, everyone. And today is the second day of the GMP Equalisation Week. We're focusing on the transfer guidance that was issued in August this year. It was issued by the Equalisation Methods subgroup, which I have the privilege to chair. Before we get into the meat of it, let me just tell you a bit about the subgroup. We were formed in March 2019, 21 very eager and enthusiastic pension professionals made up of actuaries, administrators, lawyers, and pension managers, and some people from the insurance industry. And really the task was to come up with some guidance to assist schemes to deal with the Lloyd's judgment, the 2018 Lloyd judgment. The 176 pages long it was. We quickly worked out that there were a number of gaps in that judgment that needed to be filled, and our task was to work as a team to come up with suggestions as to how to fill those gaps. We called those gaps dark corners, and we published our main guidance in September 2019 on methods. We knew at the time that there was a final instalment of the Lloyd's judgment that was confined to dealing with transfers. So we knew that there was a massive dark corner around transfers. We had to wait until November last year, November 2020, seems a long time ago now, and we got the judgment from Lloyd's. It's actually Lloyd's number 3, we call it Lloyd's 20, 117 pages dealing with transfers out and a bit about transfers in. So we got the band back together and produced the guidance in August this year. So some of you may have been on holiday when we actually published the guidance, but we didn't want to delay the publication because this is such an important issue for schemes. So Justine, if we could have the next slide, please. So we put on this slide a picture of the front cover of the guidance. It's not as well designed as the communication guidance of yesterday, that was issued yesterday. That's because it was written by actuaries and lawyers. So it started and ended as a Word document. The front cover, though, is colourful. What we're going to talk about today is in the same order as the guidance. We're going to go through an overview of what the judge said in Lloyd's 2020, and then look at what it means for what we call transferring schemes, and then what does it mean for receiving plans. And we called them receiving plans deliberately because not all transfers went to a contracted out salary related or final salary pension scheme. Some of them will have gone to DC plans, particularly more recent transfers that have been done as a result of freedom of choice. And then we have a separate category where we're talking about bulk transfers. These could be transfers as a result of a merger or indeed as a result of a corporate transaction. Normally those transfers are done without consent of the member. And we felt that that separated bulk transfers from the considerations that apply to individual transfers. As Paul said, we're joined by Geraldine, who will talk more about the practicalities of implementing Lloyd's 2020. And I'm certainly seeing a lot of practical issues arise with trying to implement the judgment and deal with historical transfers out. Justine, next slide, please. So, in a nutshell, what did Lloyd's 2020 decide? I think the main decision was that if you are a transferring scheme and you paid a transfer value in respect of a member, and that transfer value covered benefits that had accrued between 1990, the famous Barber date, and 1997, when GMP ceased accruing. So if there was a GMP element included in that transfer value, then potentially the member hasn't received the full transfer payment that would have been paid had the scheme equalised for the effects of GMPs back at the time it made the original transfer. We call that top-up payments, and we call it top-up payments because the judge was very clear that it was, if you like, an obligation on the transferring scheme to make good that top-up, make good that payment. The former member is no longer entitled to any residual benefit under the scheme, so they're not a member of the scheme as such from a trust law point of view. And I think this part of the decision is causing a bit of concern, and we'll touch on it in a minute, regarding the tax treatment of payments. The judge also held that discharges given by members when they transferred out, so they will have signed a form saying, I confirm this is in full satisfaction of my rights under the ABC scheme, they don't hold water, and nor do the statutory discharges that apply to schemes that are paid a statutory transfer value. The forfeiture provisions in the rules, so quite a few schemes have rules that say if a benefit is not claimed within 6 years, it is forfeited. In the 2018 judgment, the judge decided that past underpayments of pensions would be forfeited if the forfeiture rules applied, so you'd only have to pay past underpayments for a 6-year period. However, in this case, he decided that forfeiture provisions didn't apply because potentially it wasn't a benefit, and maybe a bit depends on the actual wording of your forfeiture provisions. But I think most people are not relying on forfeiture provisions for transfers out. And unfortunately, the judge decided that there is no limitation period, and I say no limitation period for ongoing scheme. The rationale for the judge is that under the Limitation Act, normally a breach of trust claim, you have 6 years to bring your claim. If you bring it after the 6 years, it's out of time. However, there is a provision in the Limitation Act that says if the trustee still holds trust assets, then time doesn't start to run. There is no time limit for bringing claims. So the judge held for Lloyd's that because the Lloyd's trustees still hold trust assets, there is no limitation period, effectively meaning they have to go back and look at all transfers that have taken place since the early 1990s, let's say 1991 perhaps, and check to see whether top-up payments are due. There was a recent case concerning the Axminster scheme where the same judge, Mr. Justice Peter Morgan, was asked to reconsider the limitation period, and he went into quite a lot of detail into his analysis and confirmed that he continued to hold the line that for an ongoing scheme with assets, there is no limitation period. But he did say that former trustees, because they are no longer in possession of trust assets, there is a 6-year time limit, which leads us to consider whether, if you are winding up a scheme or and distributing all the trust assets, whether a different limitation period would apply. Or perhaps if you've changed your trustees by perhaps moving from individual trustees to a trust company, that claims against the former individual trustees are now time barred, and whether members could actually bring a claim against the new trust company, given that it wasn't around at the time of the alleged breach of trust. So we think limitation periods are a hot topic, but for most ongoing schemes, I would advise that there is no limitation period. Now, the judge was asked, how proactive do the trustees need to be? Can they just sit on their hands and wait for claims to come out of the woodwork? And he decided that no, they need to be proactive. And this is a quote from the judgment. So they need to be proactive. But what does that mean in practice? And he said they must consider the rights and obligations I have identified, the remedies available to members, and the absence of a time bar, and then determine what to do. This "and then determine what to do" maybe gives trustees some leeway. But Justine, if we could move to the next slide. So part A of the guidance looks at consideration for transferring schemes. And I suppose the first point on this slide is timing of correction exercises. There is no limitation period, forfeiture rules don't apply. So might trustees think, well, there's no hurry in us dealing with this, excluding schemes that are winding up. And we actually think that schemes are likely to go through their GMP equalisation exercise for their existing members, their pensioners and deferred members, before turning to correcting their top-up payments for former members. And I would note at this point that the Lloyd's 2018 judgment came out nearly 3 years ago next month. Most of my ongoing schemes have not yet adjusted benefits for GMP equalisation. This is a slow process, and you might say painfully slow, because some of the schemes that I'm advising that are winding up, they're making payments of about £15,000 to people in their 80s and 70s. Really, I would say the industry ought to get on and get these payments out, because people are dying being owed quite considerable sums of money. Right, I'll get off my soapbox now and move on to the next bullet point, which is, this is very important for trustees, and Geraldine's going to focus on it in a bit more detail. But there is we'll never get perfection. You will never be able to get a transferring scheme to have calculated accurately and paid out all of its top-up payments. And the main reasons for this is a lack of data. Some schemes won't even have data sufficient to calculate. So if they got some data, the actuary and the administrator might be able to make some assumptions, but in some cases there just won't be enough data in order to perform any form of calculation. What do you do there? And then even if you've got data, what are you going to do if you can't trace the member? Maybe they moved abroad or they died since taking the transfer. Decisions need to be made there by trustee boards. And even if you've traced the member and calculated that they're due a top-up payment, you've still got to engage with the member and I think the communication around engagement is going to be key here. And again, I think Geraldine's going to cover that in a bit more detail. Now, in the Lloyds 2020 judgment, the judge thought that top-up payments would be paid to the receiving plan, and I think he thought that that meant the plan that received the original transfer value. I suspect in practice, not quite a few receiving plans may no longer exist. They may have merged, they may have wound up and transferred to an insurer. They may be in the PPF, or the former member may have retired and taken all of his or her benefits from a DC plan. But the judge recognised that, and he did say that it was possible to pay cash to members or reach some form of settlement with members. But that brings in a lot of tax considerations. I'm spending a lot of time looking at things called relevant accretions. The legislation allows for where someone has transferred out, if you discover a new benefit after they've transferred out, and in the words of the guidance from HMRC, the Pensions Tax Manual, if, for instance, a court case decides that a member is entitled to additional benefits after they've transferred out, then provided the payment is less than £10,000 and a few other conditions are met, you can treat that as a relevant accretion and pay a cash sum, less tax, to the member. The issue, as I mentioned earlier, is the judge was quite clear in his judgment that the top-up payment is not a benefit. Now, we don't know whether HMRC are going to take the view that a top-up payment for tax purposes is a benefit because they've got an entitlement to a top-up payment. I would say that's a form of benefit, although it's not a benefit for, if you like, a trust law point of view. It would be helpful if we had some guidance from HMRC on this issue, and I believe the PASA Tax Committee may be looking at this. In our guidance, we suggest that trustees should adopt a policy for dealing with transfers out. How are they going to address these issues, recognising there isn't perfection? And I sometimes call this a letter to themselves. It's really a record of the decisions they've made, so that if they're challenged at a later date as to why they took a particular action, it's been recorded and they've taken advice on it. And I think hopefully some sort of policy would protect trustees from claims in the future. But I think as well as dealing with transfers out, trustees should consider what they're going to do for transfers in, and we'll come on to that in the next slide. But before we get there were a couple of points we did consider on the committee, in that could you put some sort of offer to members? I said that the judge said you could compromise or settle claims. It costs quite a lot to calculate a former member's transfer out if you can actually find the data and then find the member. Some schemes would dearly love to say, let's just come up with some sort of scale. We'll do a rough and ready estimate, and we'll go to members and say, look, we want to save the cost of calculation. Would you accept, I put on the slide £50, and accept that as a full settlement? You may not be entitled to any top-up payment, but you might be entitled to a top-up payment. I think we were nervous of this as a group because you will have winners and losers, and also society has become a bit PPI claims focused, and if someone comes to you and says, would you accept £50, you might say, well, obviously they think my claim is worth more than that. So we think that sort of arrangement won't arise in practice. And interestingly, I'm starting to see the first actuarial calculations for what top-up payments might look like, and they're quite significant. I'm seeing figures of £30,000 being spread around. Another point is, if you're a large scheme, you might want to go to the court to get sign-off on your policy, and that can be done through a process such as a consent order or something called a Benjamin order. Obviously, that's not something that's open to all schemes because the cost of going to court is very significant. Next slide, please, Justine. Now, the role of the receiving plan was probably the area where the subgroup spent the most time in discussion, because we feel that the law in this area is not clear. We have the 1993 judgment of the European Court in Colorado, which says if you move pension schemes as a result of change of work, and the transfer value paid was unequal, then the receiving plan has an obligation to correct the inequality in the transfer value received when the individual reaches retirement age. Contrast that with the judgment of in Lloyd's, and the judgment in Lloyd's is that the receiving plan effectively is required to equalize the benefits it agreed to provide as a result of a transfer in. There are differences between the two, and it's hard to rationalize them and reconcile them. And then we questioned, does Colorado actually apply to a normal individual transfer from scheme A to scheme B, or does Colorado apply just to the facts of the Colorado arrangement, which was a bulk transfer from one DB contracted out scheme to another DB contracted out scheme? This wasn't discussed or argued in the Lloyd's case, and that's, I think, unfortunate, because in 2018, the barristers for all three parties agreed that the Lloyd's scheme was under an obligation under Colorado to equalize the transfer value received. I think there are good grounds to differentiate Colorado from individual transfers. Now, schemes are going to need to take their own legal advice on that, but I think what should the next bullet is, what should receiving plans do with benefits granted in return for the original transfer payment? We think if the receiving plan is a DC arrangement, it's most unlikely that they'll have to equalize for the benefits they provided as a result of accepting the transfer in, because there should be no inequality. You will have a money purchase account. Question whether Colorado applies. If Colorado does apply, the DC receiving plan can't do anything until it's approached with a request to accept a top-up payment from the transferring scheme. And then I suspect most DC receiving plans will, if the member consents, and that's the important point, accept the transfer payment across and add it to the member's pot. Not sure, I doubt there'll be any tax implications with that, although there might be something around the edges with the interest, albeit very small, that's applied to the transfer payment. And the most common thing in my experience is the DB scheme would have received a transfer, would have been told that the transfer is X £1,000 and includes a GMP of Y. They would have converted that into some form of service credit, usually a period of years and months in the receiving scheme, using the receiving scheme's basis. And I suspect in practice, those schemes are going to treat the service credit in the same way as they would treat members' benefits had they accrued as a result of pensionable service in the scheme. And that should comply with Lloyd's. Indeed, some schemes won't be able to separate out the service credit from the actual period of pensionable service. There will be some data issues around the edges, how much of the transferred in GMP relates to post-1990 service and those sorts of things, but those can be dealt with by using assumptions. Some schemes provided fixed pension payable at, I don't know, age 60 or 65 as in return for a transfer in. And I think that's a difficult issue as to how you GMP equalise that, because the fixed pension was effectively the value as the transfer received. If the member had been of the opposite sex, their fixed pension would have been a different amount. And then we discussed what would happen if you're the receiving plan and you choose, when approached by a transferring scheme, to accept a top-up payment. What should it do with it? And now, for a DC plan, we thought it was easy. As I said, you would just add it to the member's pot. For DB, options range from, well, you just pocket it and say, well, we pocketed it and we've complied with Lloyd's by equalising the unequal benefit we offered you. But then you've got a situation where someone is a member and has been told, well, we paid a £10,000 top-up payment to scheme ABC, and the member says to scheme ABC, what additional benefits do I get for that £10,000? And they say, well, nothing, because we've used it to equalise your the benefit, the service credit we provided you. But that service credit may have been advantaged, so it doesn't need to be equalised. So the member has got nothing for his £10,000. That's a risk, I think, with pocketing it. There are suggestions you could go back and do a recalculation of the original transfer in and put the comparators GMP in there and add the top-up payment. It gets really, really quite complicated. So where we've got to, I think, in practice is receiving plans may not be too keen, particularly DB ones, too keen to accept transfers in respect of top-up payments. And they might say, well, no, if you want to discharge your obligation for a top-up payment transferring scheme, go and pay the money either as a relevant accretion if it's less than £10,000, or go to, I don't know, a DC plan, get the member to set up a DC plan. Because we have done our GMP equalisation for all members, including the member that you want to pay a top-up payment for. We're not inclined to reopen the book and try and recalculate their benefit, because it's going to confuse the member quite a lot. He's received something saying we've totally equalised your benefits, and then a year or so later he gets another communication saying, oh, we made a mistake. So that's what we think receiving plans will do in practice, but I'll be interested in questions or observations during the latter part of this morning. Next slide, please, Justin. Bulk transfers, as I said at the beginning, we think it is a different category. We think in most cases the receiving plan has fully accepted the obligation to equalise, and that probably means there is no obligation on the transferring scheme to pay top-up payments. You might want to check bulk transfer agreements to make sure that there was no sort of indemnities for GMP equalisation or barber periods and things like that. But in practice, we think the liability sits squarely with the receiving plan. And indeed, some of the transferring schemes will no longer exist. Most of my clients that have operated many schemes in the past have taken the opportunity to consolidate them into a single scheme. And after that, the transferring scheme ceased to exist. The other issue that needs to be considered is members who transferred out of a scheme and then the scheme subsequently merged with the receiving plan. I think we need to look at the merger agreement to find out, or the bulk transfer agreement, to find out who accepted the obligation for these, if you like, creditors who are potentially due a top-up payment. And what I'm finding from going back, looking at merger agreements for my schemes, is that normally the merger agreement obliges the transferring scheme to accept members, pensioners, deferreds, and sometimes active members as part of the merger. And there is no provision that says, and we will accept all liabilities of the former trustee. I'm interested in how the PPF/FAS are going to react to the Lloyd's 2020 judgment. I had a look at their GMP equalisation guidance yesterday, and currently they do not look at what we call no further liability cases. So they don't look at people who died before the assessment period start date, where there is no survivor's benefit, is my understanding. And they certainly don't deal with people who took a transfer out in the past. But when I look at the legislation, you could say there's an obligation on the PPF, because all assets and liabilities of the scheme transfer to the PPF. So it will be interesting to see what the PPF come up with. And indeed, that may shape how industry reacts. Now, I've spoken for far too long, so it's now the next slide to introduce Geraldine.
Good morning. I hope you can all hear and see me. So thank you for that, Duncan. A very, very hard act to follow, lots of useful information there. So I'm going to follow up now with just 2 or 3 slides that will look at some of the practicalities of implementation, and I think we'll build on some of the points that Duncan has already made. So Justine, if we can move on to the first slide, that's super, thank you very much. I couldn't resist a little graphic, chicken and egg. I think that's really because we need to think about what we do first in terms of these particular types of projects, to look at these past transfers out, and hopefully why I'm saying that will become clear as we go through this slide. But before going into the detail, however, in drafting the administrative aspects of the guidance, we work very much on the basis that trustees who undertake this exercise are going to want to do this as cost effectively as possible. We also spent some time as a group thinking about how this work might be completed using different resource to that required for the GMP equalisation projects for existing scheme members. This is back to Duncan's point about when do you do this, bearing in mind some of these sums might be quite large, and some of the people who are due these additional sums of money might be quite elderly. So we thought actually there will be instances where schemes, trustees will not want to run these projects consecutively, but potentially do them concurrently. And we recognise that that would certainly be the approach potentially where a scheme is, for example, on a trajectory to buy out. So we did work on those 2 principles as we were drafting the guidance, that, you know, this is going to cost trustees money. Let's see how cost effectively we can do it. And let's think about the timing. And I think that issue around timing has been brought into ever more focus now, with the focus that there's been on capacity in the industry, but also that we know we've got other things like pensions dashboard on the horizon with their compliance timelines. So as Duncan's already referenced and highlighted in his presentation, not every former member who forms part of the in-scope population will have been disadvantaged. And this is where we come to a little bit of the chicken and egg, because we don't want to do work for every member who's got GMP accrual post May 19 who's transferred out if they've not been disadvantaged. So we really need to get down to that disadvantaged population. So I think trying to understand how we can do that is really important. So an initial first step, therefore, would probably be to engage with whoever is undertaking the calculations, the top-up calculations for you, to see if you can at least disadvantage or identify the disadvantaged members from the data as it stands. Now, that may or may not be possible. You might end up with a slightly bigger population than you need, and to narrow that down. But actually, if you can do that, then it saves time and money potentially analysing and cleansing data, reviewing and cleansing data for members who haven't been disadvantaged. So it's really about what's the minimum amount of work that can be done to get completed to that point where you know the disadvantaged members. As with the GMP equalisation projects, which we're seeing now through our experience for current members, there's going to be a number of decisions that trustees and or scheme sponsors will need to make. Those decisions will will influence the scope of the project that we need to complete. So when we start thinking about the planning and the due diligence phase of the project, it's likely to be beneficial if as many of those decisions can be made upfront as possible. And Duncan's highlighted some of them, and I'll go through them again shortly. So we're going to have another look at those because it is an important part from an administrative perspective of scoping and planning the project. As you can probably imagine, I'm enmeshed in GMP equalisation projects, as Duncan probably is every single day. And if I've learned one thing about GMP equalisation projects, it's probably, or certainly, to expect the unexpected. And we're never going to be able to preempt different situations that we're going to come across through Lloyd's 2020 projects in the same way that we're finding that on GMP equalisation projects. What that means is trustees having a structure that gives administrators, actuaries, legal advisors access to the decision makers throughout the project is going to be really important. And Duncan mentioned, what do you do if a former member has died? So, you may obviously want to wait till you've done your mortality screening, see how many members might be in scope, so how many former members have died, but then what do you do? And that decision could be influenced by the amount that member would have been due, when the member died, so was it 5 years ago, 10 years ago, 15 years ago, and so on. So at that point, that's when we would need access to those decision makers, and it may be appropriate that that is the right time to do that. Again, part of the due diligence phase, just agree the reporting that's required as we go through the project and how frequently the trustees would like that reporting. Now, when I drafted this, I thought, oh, the population will all be defined up front. There'll be a nice, neat, ring-fenced group. And in theory, that should be the case. However, if you have not yet equalised your CETB basis, which we know some schemes haven't, this population that we need to revisit could be continuing to grow. So just bear that in mind when you're doing your planning. But let's work on the basis that it has been equalised. We've got a sort of a nice, neat ring-fenced population. So all the reporting every time should be able to reconcile back. And that's going to be really important, back to Duncan's point about there'll be people we can't find, people who are no longer alive, people who don't engage. Duncan's already referenced the importance of policies from an admin perspective. For us, an audit trail and the records that we keep are going to be really, really important. If we can't track a member down, we need to be able to go to that individual's record and see that we have done what we could to find them, because if they then come forward with a claim in the future, we're going to be able to want to say, yes, we did try and find you, yes, you were due a top up, and this is how much it was at that time. So it's for individual schemes, I think, to decide how they want to approach contacting the in-scope population. But again, documenting that approach and the rationale, it gives good governance for any future claims. And then linked to the above, whatever the outcome, and I've tried to allude to this in what I just said previously, let's keep a record of it on that member's record. So they're going to fall into a number of categories. They're either going to be not disadvantaged, so no top up is due, but then let's just record that, and at least we know we've looked at it. We haven't got to go back through old files and try and find out, well, did we look at this person or didn't we? If a member's been disadvantaged, but the amount was very small, so, if the trustees did decide to apply a de minimis figure, let's record that as well, because we'll know what was done and the decision was made. And again, let's look at members who we couldn't contact, engage with, whatever it is, whatever the outcome, we should only ever have to do this exercise once, and then we should be able to rely on the records that have been kept for any future claims or queries. So I think it's quite likely, highly likely, that your administrator will have already thought this through. So an early conversation, I think, with them would be really, really helpful. And then lastly, costs and budget. So some schemes are coming to me and going, so Geraldine, you know, can you give me an estimate for the cost of doing my historic transfer project? It's actually really difficult to do that. So, you know, we can, but much of the cost will be almost per capita driven. So it'll be driven by the numbers of members in scope, and therefore actually, you know, preparing a budget involves making an awful lot of assumptions. So just theoretically, say you start with 100 members, of that perhaps only 60 have been disadvantaged. So at the outset you think, well, I need to write to 60 members, but then you do some mortality screening and some residency checking, and that you find of the 60 members, 5 have died and 15 can't be traced. So actually you've only got to write 40 to try and pay the top up. So the point I'm trying, probably very badly, to make is that you won't know those numbers until your project starts and until you get the outcomes of some of the activities you're going to undertake. So that makes actually quantifying the costs very difficult. And this theme continues as the project progresses, how many of the in-scope population apply and so on. So it's not impossible to prepare a budget, but it will necessitate a number of assumptions. Justine, if we could move on to the next slide, that would be super. Thank you. So this graphic is lifted directly from the guidance. We called it the funnel. Whether that's right or not, I'm not sure. We perhaps should have made it a different shape, but there you go. But hopefully you're already going to be familiar with this, but it supports the point that Duncan made, and which I kind of covered on the previous slide, about the importance of not understanding only the population, but then narrowing that down to the number of payments that could actually be made over time. But again, I restate the point, let's keep reconciling back to the starting number to make sure that we've got an outcome for everybody. We'll look at policy on the next slide, but as I said, the first step is to find everyone with GMP accrual post 17 May 1990 who transferred out. But bear in mind, this can only be based on the information that you have. So if you're aware, for example, that on a transfer between administrators, some no further liabilities weren't transferred, then actually there's nothing you can do proactively. You know, you're just going to have to really recognise that that's the case. There's very little you can do other than deal with individual member claims as and when they should arise, and that's probably the only way that you can approach it. But you will get down to a known disadvantaged population. And when you do that, then the next step is to review the data and obviously fill in any necessary gaps. Now, I use the word necessary quite deliberately because a first step really is a discussion between your administrator and whoever's completing the calculations, probably the scheme actuary, about where is data cleanse absolutely necessary, because data cleanse can cost a lot of money, or where can you use in some assumptions instead. And it comes back to the point about, you know, only doing the work that really needs to be done to get these payments made. We've talked about the possibility, the likely possibility that members may have moved or former members may have died since the transfer value. And therefore, in the guidance, we're suggesting that, you know, before you do anything in terms of communicating with these members, undertake mortality screening, both from a sort of practical but also a sensitivity perspective. We don't want to be writing to people who died 10 or 15 years ago, potentially, and do a basic residency check. You know, it's about data protection and not writing out to people where they may no longer be at the address that you had. The residency check may come back with a new address to show that the members moved, but if it doesn't and you can't trace them again, what decisions are the trustees going to make about, actually, do I want to do any more to try and find that member, or am I going to sit tight and see if they contact us? But all of these, again, are potential to reduce the numbers in scope. But what do we do if a new address comes back? Because normally we would verify that. But actually, to, again, make the project cost effective, we can do perhaps the verification and the initial communication as one letter, not giving any sort of, you know, figures or amounts or information that we wouldn't want to fall into the wrong hands, but just saying, we think you're somebody who transferred out, please can you contact us? And then obviously the population could be further reduced if members fail to engage, and the content of the communication is going to need to be very carefully thought through, because people are so aware of pension scams these days that there's a very real risk that they'll get a letter from, you know, their administrator, even if it's badged from the trustees, but think that it's part of a pension scam. So, you know, hopefully working through the funnel and understanding where people will fall out of scope for these projects illustrates the previous point about, you know, scoping out the work in terms of the numbers is going to be difficult because the outcomes will vary at different points of the process. And then just the last slide, Justine, so we have a little bit of time left for questions. You know, any project that we do in pensions, it's you know, all driven by the scope, and I think, as Duncan and I both highlighted, the decisions that trustees make as part of their planning can really impact on the scope of this project in particular. You know, we will go through a planning and due diligence phase, and the more of these decisions that can be made as part of that phase, the better. But it isn't always going to be possible. But you know, let's pull together a checklist and think, you know, here are all the things that we need to know. Even if we can't decide on them all right now, let's make the decisions that we can and know that we've got to come back to the others. So in preparing for this session, I've, as you won't be surprised to know, been through the guidance, so I have to tell you it's not the first time I read it, and pulled out some of those decisions. So I'm just going to sort of canter through those and highlight why each is important from a practical perspective. I referenced previously a de minimis. You know, there is a cost benefit to some of these payments. You know, if it highlights that a top up is due of £20 and it's going to cost £250 to pay it, will the trustees decide, well, actually, you know, it makes sense to have a de minimis? If that is going to be a decision, then knowing that upfront can avoid doing unnecessary work. You know, we won't be sourcing missing data or trying to trace people if we're actually not going to pay the amount of money to them. But again, back to my earlier point, let's note the member's record to say that that member was due a top up and the amount, and then we've got that information should the member come forward in the future. Duncan referenced payments, whether they should be made to the member or a receiving arrangement or another arrangement. So whether that's, you know, the previous receiving arrangement or a DC scheme perhaps that's been set up. That can significantly impact the amount of work required, because paying it to a receiving arrangement is likely to result in a lot more work than paying it directly to the member. Certainly a lot more correspondence, probably back and forth between the two schemes. So again, knowing that early can help us scope the work and obviously potentially cut down the amount of work that we need to do. Knowing the basis for calculating the top-ups drives the need for data and means work looking at historical files can be kept to a minimum. Again, really another key learning from GMP equalisation projects. The closer the advisors work together, the more efficiently and cost effectively the project can run. We need to check the position potentially on non-statutory and statutory transfers, but based on my experience, and as we know, I've worked for one or two organisations, many administration systems simply don't differentiate. So, you know, it will be the same, probably the same decision for statutory and non-statutory. We can sometimes derive it for some members, for example, through checking age at date of transfer, you know, within 1 year of NRA, but we're never going to capture everybody. So decision needs to be made: do we treat everybody the same, or do we try to differentiate in any shape, size or form? Think as well about special circumstances. So has there been an enhanced CETV exercise? Anything that might impact on a group or a section of members, let's capture that up front and agree with everybody, you know, we're going to go for the 80-20, we're going to do the bulk and come back to this small group, but how are we going to approach those particular members? And finally, I know we've talked about historic transfer values, but as I said earlier, for some schemes, the pile is still growing. And I think this brings into focus the need to get to the point where we're paying equalised CETVs. But if that isn't the case yet, then we do need to take care to make sure that we keep filling the funnel, the pot, with transfer values that we're paying out at the moment that are still on an unequalised basis. And then lastly, I've really focused here on the decisions for the transferring scheme, but Duncan has equally called out the decisions that you're going to need to make as a receiving scheme and how that might impact on the administration. And indeed, I could actually see that we could get to the point where we need those transferred in decisions before we need the transferred out decisions. So, you know, probably something to engage with your administrator on now. A lot of the guidance is focused on the strategic or policy decisions, and that's quite right, because we need to get those up front, but there will be operational decisions to make as well. You know, really minor points about, are we going to chase people once or twice or not at all? But, you know, again, let's think about those up front and get those captured as part of our project planning. So something of a whistle-stop tour through the practicalities. I hope it was helpful and provided food for thought. Illustrated how important it is to talk to your administrator, get them on board, talk about timings for your project, but also to invest that time in the due diligence and planning phases. And now, with a little bit of time left, because I've whizzed through that as quickly as I can, I'm going to hand back to Paul for questions.
Thanks, Geraldine, and thanks, Duncan. We've got quite a lot of questions, so we'll get through as many as we can. I'm able to stay on for an extra sort of 5 minutes, possibly. I don't know if Duncan and Geraldine are. If they are, that will be great. Right, now I won't attribute the questions, not because, just for practical reasons, that will be my ineptitude driving the software. But the first question I've got here is, for a scheme which needs to resolve this issue in order to wind up, what approach can be used for members where no data is held, perhaps only a TV amount and a name from a cash book? Can settlement payments be based on a very high level estimate? And I think that's probably a question for Duncan, but if you have a comment to that, Geraldine, please do.
I think there are two ways. One is if you can reach the former member and contact them, you might offer them a settlement. The alternative is to proceed to wind up without settling that liability, but to seek to protect the trustees against claims that may be made after the wind up is completed. And I think in practice, we're not going to see insurers willing to take this liability. So the liability effectively will fall onto the employers. So as Geraldine says, you'll probably have an admin record that says this person took a transfer out. We don't know what the transfer, whether it was unequal, whether it needed adjustment, but you know you potentially have an unquantified liability. And I think that in practice we'll have to pass it on to the employer.
Okay.
Just from a practical perspective, I can envisage a situation where all you've got is a cash book entry. So, you know, in reality, you're not going to be able to trace the member. You know, if you've got no date of birth, no last known address, that kind of thing, it's going to be a physical impossibility to find them. You know, your only hope is that the cash book has details of the receiving scheme. And if the receiving scheme still exists, you might track down the member that way. But I think other than that, you know, it literally is going to be a case there's nothing you can do, because there is no tracing service that, as far as I'm aware, that will work on just a name.
Okay, next question. Why is the receiving scheme, as well as the transferring scheme, responsible for equalising benefits? It wasn't the scheme's fault the CECVs were underpaid.
That's a very good question. And I think the answer is because the judge in Lloyd's said the receiving scheme is responsible for equalising the benefits it agreed to provide. It's unfortunate, and the judge notes this, that no one argued to him that a transfer value received by a receiving scheme is not pay for the purposes of sort of Barber and equalisation. And I think there is an argument that it isn't pay, but the courts haven't heard that argument. But the reason that they're under an obligation as a receiving scheme is because the judge imposed it in Lloyd's. And there is a theory that the European Court of Justice imposed it in Colorado.
Okay, thank you. And another question, I think this possibly is for you, Geraldine. Are some schemes looking at transfers first? I'm finding a few because of different resources being required. And with TVs, they're less mixed up with other ongoing projects?
So yes, we are actually seeing some schemes now starting to look at their historic transfer values. From an admin perspective, this is going to sound like a very strange thing to say, but it is more of an admin job. We don't need the level of pensions expertise to equalise or to pay out these top-ups, because typically we're finding that the scheme actuary will give us the figures that we need to pay. So it then becomes very much about, as I say, administrative work rather than pensions technical administrative work. So I think this comes back to the point about we can use different resources, so it means we can do these projects in advance or concurrently with the projects to equalise the benefits for current scheme members. So we are starting to see some trustees recognising that and thinking, well, actually, while I make my methodology decision, I could crack on and start to get this project done.
Okay. The next question is, in practice, do we think schemes will start by trying to pay TV top-ups or cash relevant accretion, if I've said that properly?
Yep.
Accretion, yeah.
My take on this, Paul, is that schemes will write, if the top-up is less than £10,000, so you can potentially pay this relevant accretion, and you're comfortable on the tax, which I would hope people will get comfortable. I would write to the member and say, after having verified their identity, etc., and communicated with them, the second communication will be, we've identified you're due a top-up of £6,500. We need to pay this either to a pension scheme that you nominate that's prepared to accept it on your behalf, or we can pay it to you as cash, less tax. I suspect you'll get far better member engagement if you're offering to pay someone £6,500 less tax as a cash lump sum than you will if you're asking them to nominate a pension scheme to receive this sum of money, particularly at the lower ends.
And certainly from an administrative perspective, that will involve a lot less steps, and therefore again help with managing the costs of the project.
No, I can see that. Okay, this is a question, and whoever comes first in answering this one, given the difficulty in calculating what CETV should have been, do you think that pragmatically calculating the value of the effect based on GMPs at today's date using the current CETV basis could be an acceptable methodology? Possibly that's for you, Duncan, actually, but
okay. I think from a legal point of view, you should actually use the transfer basis that was used to calculate the original. I'm mindful that a lot of schemes use the MFR basis back in the 90s, early 2000s, and the CETV rates have gone up significantly over the last few years. So we're now seeing 35-40 to 1 as a factor, whereas back in 1997 it would have been significantly lower than that. So if you calculate it on today's basis, you're going to be overcompensating. I think in practice, however you calculate it, you've got to be able to say that it's an appropriate approach. And let's face it, no one's going to come back and claim that you miscalculated it. Geraldine.
Yeah, I mean, what we're seeing at the moment, and this is where we probably could do with some actuarial expertise on the call as well, is that, you know, we are seeing proposals that says we're going to use a pragmatic approach, which implies that it won't be full reconstruction of the transfer value, but on the basis that was applying at the point when it was paid, that it will be some sort of pragmatic approach that actuaries will use, which is probably, I think, with my administrator hat on, what I would have expected.
Yeah.
But that's unlikely to be today's basis, I would say.
Yeah, thank you. Next question, which is a statement and a question. I think receiving schemes will equalise the benefits in their scheme as best they can, including any transfer credits and write off any expense.
Attention, please. Attention.
It wasn't me.
I can promise you it's not my house either.
No, it looks like I'm in a building that's got some kind of problem. So can I hand over to either Duncan or Geraldine to see the questions, because I think I'll be leaving the building.
We are investigating a condition.
Okay. So it's really quite difficult to read these questions. I will try my hardest. In practice, do we think schemes will start by trying to pay TV top-ups? No, we've done that one. Given the difficulty, we've done that one.
I'm just wondering, as we kind of hit our 11 o'clock deadline, whether a good suggestion might be that we take the questions away.
Yep.
Perhaps send something round afterwards, because we've lost our chair. So we're and I'm conscious people have probably got this hour set aside in their calendar. So if everyone's comfortable, which hopefully you will be, perhaps we take them away and prepare just some brief notes afterwards to circulate to the people who've attended the webinar. Does that sound all right with you, Duncan? Seeing as I should be calling on your expertise as well.
Perfect. That works well. And let's hope Paul is safe.
Yeah, he was just telling us how he moved into a new building, so obviously they're testing the fire alarms. So shall I just take over and just leaves me to say thank you very much to everybody for attending the call today. I hadn't prepared anything because Paul was going to do this, but I hope you found it really useful. If you're joining us for the other webinars during the week, then I look forward to hearing and speaking to you again. But not too much, you'll be pleased to know. Otherwise, have a great day, and we'll send through some more information for you in response to your questions. Thank you, everybody, and goodbye.